let me start with a number that should honestly make you a little bit angry. Over the last 10 years, one of the most popular pieces of investing advice on the entire internet has been 3 simple words: just buy VOO. Buy the S&P 500, hold it forever, ignore the noise. And I want to be completely clear right at the top. That is genuinely good advice. It is not a scam, it is not a trap, and for most people, it will build real wealth. VOO returned about 15% a year over the last decade, and 15% a year is fantastic. If someone handed you that and nothing else, you would still retire comfortable. But here's the part nobody tells you. Over that exact same 10 years, another regulated, publicly traded fund quietly returned about 34% a year. Not for one lucky quarter, not in a single crazy bull run. For 10 straight years, right through the 2022 crash that wrecked so many portfolios. Now, stop for a second, because I know exactly what your brain just did. It heard 34% a year, and it whispered, that has to be crypto, or some meme stock, or one of those leverage products that eventually blow up and take your account with them. And that is a completely fair instinct. But no, this was a boring, regulated, publicly traded, exchange-traded fund. The kind of thing you can buy tomorrow morning in the same brokerage account you already own, sitting right next to your VOO. So the question this whole video answers is simple. If you were disciplined enough to invest anyway, which fund did that discipline actually reward the most? Let me put real money on it, because percentages are slippery and dollars are not. Say you invest $500 a month for 10 years. That is the same effort, the same paycheck, the same automatic transfer every single month. At a normal, sensible 7% return, you end up with roughly $86,000. Not bad at all. Now bump that to 15%, the VOO style number, and the same $500 a month grows to about $138,000. And at 23%, that identical $500 a month explodes past $220,000. Read those 3 numbers again. Same person, same discipline, same $500. The only thing that changed was which ticker they typed into the box. That is the whole game. And that is why the fund you choose to sit inside of matters just as much as the habit of investing itself. And I want you to really feel why the gap gets that wide, because it is not intuitive. Your monthly contributions are basically the same across all 3 scenarios. Over 10 years, $500 a month is $60,000 of your own money going in, no matter what. So at 7% of your $86,000 ending balance, only about $26,000 is growth. But at 15%, the growth alone is roughly $78,000, more than the money you put in. And at 23%, the growth is over $160,000 on top of your $60,000. That is compounding doing the heavy lifting instead of your paycheck. The higher the rate, the more the market is working for you, and the less your own wallet has to. That is the leverage hiding inside a single percentage point, and it is exactly why the right fund can quietly out-earn years of extra saving. Now, before we start the countdown, I have to give you the caveat that every honest person owes you. Past performance does not guarantee future results. It never has, and it never will. A fund that returned 34% for a decade is not promising you 34% for the next one. But here's the thing history actually gives us. It does not give us a guarantee. It gives us something more useful. It shows us which funds have real structural advantages baked right into their design, versus which ones just got lucky and are about to give it all back. So as we count down these 9 funds, do not just watch the return number. Watch why the number happened. That is the part you can actually use. Let me count them down, from 9 to 1. Number 9 is VXUS, the Vanguard Total International Stock ETF, and I am putting it on this list on purpose, even though its return is the lowest here, because of the specific job it does. VUS owns the entire global market except the United States, everything else. Roughly 40% of the world's economic output happens outside American borders, and a US-heavy investor, which is most of us, basically pretends that 40% does not exist. VUSUS is how you stop ignoring it. It holds more than 8,700 companies across Europe, Asia, and emerging markets, including real titans you have absolutely heard of, like Taiwan Semiconductor, Samsung, ASML, and Tencent. And it is dirt cheap, just a 0.05% fee, So why so low on the list? Because think of VUSUS less like a growth engine and more like an insurance policy against something Americans rarely plan for, a decade where the US market just stalls out.
If America goes flat and the rest of the world accelerates, VUSS is the piece of your portfolio that keeps moving. It is not here to be the hero.
It is here so that when the hero has a bad decade, you are not left with nothing. Number 8 is VT, the Vanguard Total World Stock ETF.
If VUSUS is everything except America, VT is the honest answer to a question most investors never ask themselves out loud. What if I just want to own the entire global economy in one click and never think about it again?
That is VT. It combines US and international stocks into a single fund, weighted by how big each market actually is. Which means, and this is the quietly brilliant part, you never have to sit there manually deciding how much to put in America versus everywhere else. The fund does it for you, automatically, forever. It holds over 10,000 stocks across 49 countries, and right now it is still about 60% US, simply because American megacaps are so enormous that they dominate the global weighting on their own. Over the last decade, VT averaged around 12% a year, with an ultra-low fee of 0.06%. This is the fund for the person who wants to be truly hands-off, globally diversified, and never touch it again. It is not flashy. It is the financial equivalent of a really good set-it-and-forget-it thermostat. Number 7 is where it starts getting interesting, and it is SCHD, the Schwab US Dividend Equity ETF. SCHD is not chasing the flashy, fast growth story at all. It goes the opposite direction on purpose. It targets 100 mature US companies that generate real cash and have long, consistent track records of paying and actually growing their dividends over time. We are talking blue-chip staples, names like Chevron, Verizon, and Mark. Companies that were here before you were born and will very likely outlive all of us. It yields roughly 3.4%, and it delivered a 12.31% average annual return. And here is a small mechanism worth understanding, because it changes how you should think about that yield. That 3.4% is not just spending money.
If you reinvest those dividends instead of pocketing them, every payment quietly buys you more shares, which then pay their own dividends, which buy even more shares.
It is a snowball that keeps rolling, whether the stock price is going up, sideways, or down. In a flat or falling market, where price growth gives you nothing, those reinvested dividends are still steadily adding to your share count.
That is a very different feeling from watching a growth fund do absolutely nothing for 2 years. But the return is not really the headline with SCHD. Its true superpower is what it does when everything else is on fire.
Picture 2022, the brutal bear market. Tech funds were dropping more than 30%. Portfolios were bleeding, people were panic selling at the bottom. SCHD, over that same stretch, fell only about 3%. Let that sink in. While the exciting funds were losing a third of their value, this boring dividend fund barely flinched. That is what steady cash flow and low volatility actually buy you, the ability to sleep at night and not sell at the worst possible moment.
Number 6 is VTI, the Vanguard Total Stock Market ETF, and this one owns literally every publicly traded company in America, not the top 500, every single one. Here is the difference that matters.
A fund like the S&P 500 stops at the big 500. VTI holds all of those same mega caps, but it also reaches down into the mid-cap and small-cap companies, the ones that are not famous yet, but could become tomorrow's market leaders. Roughly 3,500 stocks in total. The top of VTI mirrors the S&P 500 almost exactly, but the tail end quietly captures the rest of the American economy. It costs a mere 0.03%, and it is famously the kind of simple, low-cost fund that Warren Buffett has pointed regular people toward for years. It returned 14.25% annually, which slightly trails VOO over the past decade, and you should ask why. It trailed for one specific reason. Large caps dominated this particular decade, so the extra small companies were a small drag. But here is the reversal. When small caps eventually take the lead again, and historically they always eventually do, VTI is structurally built to outrun the S&P 500, not trail it. You are being paid patience for a cycle that has not shown up yet.
Number 5, and I know some of you have just been waiting for it, is VOO, the Vanguard S&P 500 ETF, the benchmark, the one the whole video started with. VOO tracks the 500 largest and most established companies in the United States, and there is a reason it has become the default answer for an entire generation of investors. Its secret is something I genuinely love because it is so simple and so quietly ruthless. The S&P 500 is a self-cleaning index. Companies that fall behind get quietly removed, and stronger, rising businesses take their place.
You never have to fire the losers yourself. The index does it for you, automatically, on a schedule, without emotion. Think about what that quietly protects you from.
If you had built your own list of the 500 biggest American companies 20 years ago and just frozen it, you would still be holding a graveyard of businesses that faded, went bankrupt, or got left behind by the internet. The S&P 500 never lets that happen. As a company shrinks and falls out of the top ranks, it is removed, and the new giant that grew up to replace it is added in its place. You are always, automatically, holding the current winners of the American economy, not a museum of who used to matter. VOO manages nearly $880 billion in assets, charges a tiny 0.03% fee, and delivered a 14.95% average annual return.
This is the gold standard for core investing, and nothing on this list changes that. If you own only VOO for the rest of your life, you will very likely do great.
Everything above this line is about what you can add around that core, not what should replace it. Okay, from here up, the returns start to climb steeply, and so does something else. Pay attention to the volatility, because it is the price of admission for every single one of these. And I know exactly what the sharpest person watching is thinking right now, so let me say it out loud before you do. Isn't chasing the funds with the highest past returns the single most classic rookie mistake in investing? You would be right to be suspicious. Buying whatever went up the most last year is usually a fast way to buy the top and hold the bag. But there is a real difference between chasing a lucky streak and recognizing a durable structure. A fund that spiked because one meme stock inside it went vertical is luck. A fund that concentrates into semiconductors during the single biggest computing build-out in human history has a reason underneath the number. Your job for the rest of this list is not to fall in love with the returns. It is to ask every single time, is there a real engine behind this? Or is this just the last decade's dice roll dressed up as a strategy? Hold on to that question. It is the one that separates investors from gamblers. Number 4 is SPMO, the Invesco S&P 500 Momentum ETF. And this is where we stop owning the whole market and start getting selective. SPMO takes that same S&P 500 you already know, and then it aggressively filters it down to only the 100 stocks showing the strongest upward price momentum, adjusted for volatility. And then, twice a year, it does something most investors are emotionally incapable of doing themselves. It automatically dumps the stocks that are slowing down and rotates into the new leaders. No hoping. No holding a loser out of pride. It just cuts and moves. At a fee of 0.13%, it delivered an 18.51% annual return, beating the S&P 500 by roughly 3.5% every single year. But here is the honest catch, and I am not going to hide it from you. Momentum investing requires a strong stomach. When the market corrects, the very stocks with the most momentum on the way up tend to reverse the hardest on the way down. SPMO buys strength, and strength, when it breaks fast. Number 3 is QQQ, along with its cheaper twin, QQQM, the Invesco NASDAQ 100 ETF. This fund tracks the 100 largest non-financial companies on the NASDAQ, and that one design choice creates a deeply concentrated bet on technology and growth. Owning QQQ is essentially a wager on the companies building the infrastructure of the entire modern economy. The holdings read like a list of the most important businesses on Earth right now: Apple, Microsoft, Nvidia, Amazon, Meta, and Tesla. Quick, genuinely useful note here, because it can save you real money. QQQM tracks the exact same index as QQQ, but with a lower fee, 0.15% versus QQQ's 0.20. Same index, same companies, lower cost. So if you are buying and holding for the long run,
QQQM is simply the smarter version of the same fund. Over 10 years, this NASDAQ 100 basket averaged a massive 20.29% return. But the trade-off is right there in the data. In 2022, it dropped 32%. When you concentrate into growth, you get the incredible upside and the gut-wrenching downside as a package deal. You do not get to keep one without the other. Number 2 is VGT, the Vanguard Information Technology ETF. And if QQQ felt concentrated, VGT is pure, undiluted technology. Here's the distinction that most people miss. QQQ actually holds some companies that are not technically tech. Amazon gets classified as consumer discretionary. Meta gets classified as communication services. VGT does not bother with any of that. It holds only companies strictly classified as information technology, the software, the hardware, and the semiconductors.
Nothing diluting the theme. And with a remarkably low fee for something this focused, just 0.09%, this hyper-concentrated fund delivered an incredible 23.34% average annual return over the last decade.
Think back to the intro. 23% was the number that turned $500 a month into over $220,000. This is the fund that actually did that. But say it with me one more time, because the theme of this whole back half is the same. That kind of return does not come free. It comes bundled with concentration, and concentration cuts both ways. And now, number 1, the fund from the very beginning of this video, the 34%. It is SMH, the VanEck Semiconductor ETF. SMH goes one level deeper than broad technology. Instead of owning all of tech, it focuses exclusively on the single foundational layer that everything else in the modern world is built on top of: chips, semiconductors. And when you really think about it, that focus is not as narrow as it sounds. Semiconductors are the literal brains behind artificial intelligence, behind data centers, behind electric vehicles, behind modern medicine. Almost nothing advanced in your life works without a chip somewhere inside it. SMH is highly concentrated in just the 25 largest US-listed semiconductor companies, names like NVIDIA, TSMC, Broadcom, and ASML. At a fee of 0.35%, the highest on this entire list, SMH delivered an almost incomprehensible 34.09% average annual return for 10 straight years. Here is what that means in dollars. A $10,000 investment made 10 years ago and simply left alone would be worth over $188,000 today. 10,000 into 188,000 from a fund you could have bought in any normal brokerage account. But I would be doing you a genuine disservice if I stopped on that number and let you run off to buy it. So here is the truth, and please actually hear it. SMH carries supreme volatility. In 2022, it fell 33%, a third of it gone in a single bad year. This is not a fund you dump your entire life savings into and then check your phone every hour, because the swings will absolutely break your nerve and make you sell at the exact wrong time. Because of that cyclical boom and bust nature, the sensible way to use a fund like this is as a satellite position, something like 10 to 15% of a portfolio that already has a strong, stable core underneath it, and only if you have a genuinely long time horizon. What makes it interesting today, rather than terrifying, is the structural tailwind. The entire world is racing to build out artificial intelligence right now, and every bit of that gets built on the exact chips these companies make. The demand is not a rumor. It is showing up in real orders. So let me pull this all the way back together, because a countdown is useless if you close the app and do nothing with it. Look at the shape of what we just did. At the bottom, VXUS and VT and SCHD gave you stability, diversification, and cash flow, the boring things that keep you in the game when the market tries to shake you out. In the middle, VTI and VOO gave you the reliable, self-cleaning core of the entire American economy, the foundation almost every good portfolio is built on. And at the very top, SPMO, QQQ, VGT, and SMH gave you concentrated, high-octane growth, along with the very real risk that rides shotgun with every point of that extra return. Here is the honest takeaway. The person at the top of that leaderboard did not win because they were smarter than you.
They won because they picked a structure with a real, durable advantage, and then they had the stomach to hold it through a 33% crash without flinching. That second part, the holding, is the part almost nobody talks about, and it is the part that actually decides who keeps the gains and who panic sells them away.
So do not just walk away and buy the 34% fund because a video told you the number. Walk away and ask yourself the real question. What is my core? And what small, deliberate satellite could I add around it that I could genuinely hold through the ugly years? That question, answered honestly, is worth more than any single ticker on this list. Now, I actually want to hear from you, because I am genuinely curious how you all sit on this. Are you a pure VOO and chill investor who thinks all of this concentrated stuff is just noise? Or are you carving out a slice for something like SMH or VGT and accepting the wild ride that comes with it? Tell me in the comments and be honest about your risk tolerance, because that is the conversation that actually helps other people watching. If this breakdown helped the way you think about your own portfolio, do me a favor and hit that like button. It genuinely helps this channel reach more people who need to hear it. And if you want more honest, no hype breakdowns exactly like this one, make sure you subscribe so the next one lands right in your feed. Thank you so much for watching. Take care of your future self, and I will see you in the next one.